Hi guys, I'm Umpili. This is Michali.
I'm Umpileti.
I'm Ovayo.
I'm Simpuri.
I'm Bukrano.
And we are
Simply Accounting.
Grade 10th. Welcome to our video on financial statements. I'll be introducing the topic before my teammates take you through each and every part in details. Financial statements are important because they help us understand how a business is performing. They show us whether a business is making a profit or not, how much it owns and how much it owes. In other words, financial statements give us a full picture of a business financial health. There are different types of financial statements and each has its own purpose. The income statement shows the profit or loss made by the business. The balance sheet shows the assets, liabilities, and the owner's equity at a certain date. And the notes to the financial statement explain each important detail behind the numbers. Right? And in this video, each member will take one section and explain it step by step, so that by the end you'll see how all the pieces fit together. Thank you.
So my part in this video is to clearly describe the GAAP principles to the grade 10 learners. GAAP principles are standardized rules and procedures that guide the recording and the reporting of financial statements. We have about 6 core GAAP principles that we focus on in grade 10. We have the historical cost principle. In this principle, assets are recorded at their original cost price. In the financial statements of the entity, they will always be recorded under their cost price and not their selling price or market value. The second principle is the business entity principle. This principle separates the entity from its owners, meaning that the books of the business are separate from that of their owners, meaning that the assets of the entity and that of the owners are separate. There will be no mixing of the personal recordings and the personal asset of the owners in the books of this entity. The third principle is the going concern principle. This principle assumes that the business will continue to operate in the foreseeable future, meaning that whenever we record something, we record it in the sense that we are still going to account for it in the next financial period. The fifth principle is the matching principle. The matching principle states that income and expenses are recorded in the correct period, meaning that if an income was incurred in the 2024 financial period, it means that it will be recorded in that period and not any other period. To ensure accuracy of our financial statements. The other principle is the materiality principle. This principle requires disclosure on all relevant financial information that could influence the decision of the shareholders. It can influence the decision of the shareholders if it is material, meaning that you cannot group a large account or an account that has a big amount as compared to your entity's revenue. You cannot classify it as other expenses. The principle emphasizes caution when making judgments under uncertainty. What this means is that income will not be overstated and expenses will not be understated. Thank you.
Hi, grade 10s, I'm Umpileti and I'll be explaining the income statement as one of the financial statements that entities use. So what is the income statement? The income statement is a type of financial statement that businesses use to record their income and expenses of the year to indicate whether they've made a profit or a loss. So in an income statement, you have about 4 components. You have the gross profit component, the other operating component, the operating expenses component, and we have the operating profit component. And at the very end of the note, we have our interest income and interest expense, and then we get our net profit for the year. So in accounting, we have different accounts, as you have been taught in the beginning of the year. We have our assets, our owner's liability, we have our income and expense, and our owner's equity. So in this financial statement, we only record our incomes and expense. So I'll be explaining the different types of accounts for each component of the income statement. For the gross profit component, we have the sales and the cost of sales. The sales is an income account and the cost of sales is an expense account. So sales is the revenue a business gets from selling their trading stock, and our cost of sales is the expenses that businesses pay, such as buying their raw materials or paying delivery for getting the raw materials. And then our gross profit will be sales and deduct cost of sales. And then we have our third component being the operating expenses. Now these are expenses that businesses pay for their day-to-day operation. We have our telephone expense, our water and electricity expense, our salaries and wages, and contributions made by the business, such as pay, UIF, and pension fund. And then we have our bad debts, our consumable goods, our stationery, and we also have our rent expense and loss on sale of assets such as our vehicle equipment. We have our trading stock deficit. Now, our trading stock deficit is when our opening trading stock is less, our closing trading stock is less than our opening trading stock. So the difference is what we call the trading stock deficit. And then we have our third component being the fourth component being the operating profit. Now this is where we add our gross profit and our other operating income and deduct our operating expense. After the operating profit, we have our interest income, which is note 1. Now this is the interest earned on accounts such as income accounts such as investments, fixed deposit, and overdue debtors. And then we have our profit before interest expense, which comes after adding both our operating profit and our interest income note. Your interest expense is interest that you pay on expense accounts such as other accounts such as our loan, our bank overdraft, and our overdue creditors. Now at the end, you have to add your profit before interest expense. You have to deduct our interest expense from the profit before interest expense, and then you get our profit for the year. Thank you.
So are we doing the 2023 November paper 1 Gauteng paper? Yeah. And I'll put a link in the description for the paper. You can get it by www.testpapers.co.za. So we'll be doing questions consisting of 44 marks, and it is just the income statement or statement of comprehensive income. This is what the answer sheet looks like. You have some amounts there written for you, and you just fill in there. And then sometimes the answer sheet requires for you to write the name of the entity, in this case Sebenza Traders. So let's start. So you have the trial balance in the beginning and a little information there that says the following information was taken from the records of Sebenza Traders on the 28th February 2023, the last day of the financial year, and the business uses a markup of 40% on cost. So if before you begin writing anything, have a little timeline, beginning of the year, end of the year, 23 Feb, and with the whole 40% gross profit on cost of sales, which means our selling price is 140 and our cost of sales would be 100%. But if they were to say that your gross profit is on selling price, then it would be 100. Your selling price would be 100, your gross profit would be 40 and your cost of sales would be 60, meaning it would be 100 minus the gross profit. Okay, now before we do anything, first thing we would do is write our sales amount minus debtors control. Debtors control amount of my mistake, minus debtors allowance, not debtors control. Debtors allowance of 6,800. So the first transaction says that the water and electricity account for Feb 2023 has not been paid and the amount is 1,830 rands. So the first one, we have not paid 1,830 rands. This means that we have to add this amount to our expense. Now in the trial balance, the water and electricity amount is 19,100. Minus 1,830. There's no transaction, so we close the bracket. The second one says that stock with a selling price of 2,520 was donated to a local orphanage. No entry was made. So number 2, we are given the selling price. We want the cost of sales. So what we want over what we have, always times the amount. So we have the amount here. You want 100 over 140, and that gives us an amount of 1,800. That would be our donations amount. Okay, so the transaction says that according to the physical stock count at the year end, we have a trading stock amount of 41,000, which is the closing, and packing material of 1,950. Keep in mind, these are the closing. We want to see if we have a deficit or a surplus. So how do we see that? We compare it with the opening. Now the opening for trading stock is 44,000 and the opening for packing material is 7,100. You can clearly see that there is a deficit. But if it were the other way around, then it would be a surplus. So to find out how much the deficit is, it would be the closing minus any transaction that happened during the year, which is the donation. We do not own it anymore, so we have to remove it from our financial statements, minus the opening. So just say open. Same with the packing material. We do not have any transaction, so that's how you would write it in your income statement. Here we have it, trading stock deficit, packing material. You can have it the other way around, where it is the opening minus the transaction that happened during the year minus the closing, and you would get 1.2. And for the packing material, you'd get 5,150. Now the next transaction says that insurance premium includes an annual premium amount of 3,960 paid for the period of 1st September to the 31st of August. Now our year end ends on the 28th of Feb, so which means the 31st of August would exceed our financial year period. Now that means that we have paid this expense prior to for the next financial year, whereas in our financial statements we're only supposed to include transactions that are for the current financial year. Now from September, I forgot. Now it says from September until August, that would have 6 months here outside our financial year and another 6 months here inside our financial year. So what we want is to deduct what is not of this financial year. So this would mean we would divide it by 12, and that would give us an amount of 330. So now because we want to exclude 6 months, we would multiply that by 6 to get an amount of 1,980. So our next expense, insurance. Do we have a balance in our trial balance? Yes, we do. An amount of 12,500 minus 1,980, and that gives us 10,520. Okay, next transaction. We have rent for February has not been received. The rent increased by 300 per month with the effect of the 1st of July. So here we had an increase of 300, and we have not received rent for 1 month, which is Feb. So what we want is the rent for the month of Feb. The first thing we have to do is deduct the increase of 300 to get the original price. So here we have, on the trial balance, we have an amount of 36,200, but we want the original rent before, so we have to minus the 7 months. From July to Feb would give us 7 months. So we're minusing 7 months of the increase. This would be 2.1. So 36,000 minus 2,100. And we get a normal amount without the increase of 34,100. Now we are not done. We want the normal amount divided by 11 because we only have 1 month left. Would give us an amount of 3,100 plus the increase would give us an amount of 3,400. This is what we record in our financial statements. So it's an income, and we'll see this amount this amount plus this amount to get the total rate for the year. Don't be like me and write the currency, just write the amounts. And we get 39,600. Okay. Next question. We have a debtor who owed 1,200 but was declared insolvent, and his estate was able to pay half of it. So which means we paid the other half for the debtor. Now your allowance for bad debt would increase with 600, but not in this case. We do not have. Okay, we do have an amount in our trial balance plus the 600. That would give us an amount of 5,400. Okay. Next up we have the loan settlement. Now here we are given, in the question we are given this table. Now we have an outstanding interest on loan amount and interest is not capitalized. So the fastest and easy. So for the loan, the interest on loan, interest expense, you're supposed to take your closing balance plus the repayments minus the opening balance to get the missing amount. Because if you add this amount, then you're going to get this closing balance. So in other words, we're working in reverse. And then we have our next transaction number 8, states that we have EFT fees of 170 and credit card levies of 90 rand and interest on current account. Interest on current account is an income, working interest income. So interest income, see, do we have a balance? Yes, we do. We had transaction of outstanding interest income, and the previous adjustment says that provide the outstanding interest deposit, interest is not capitalized. So we have an interest deposit of, this is supposed to be number 9. Number 8, we have an interest deposit of 9% on our fixed deposit, and the amount is 24,000. So 24,000 times 0.09 give us an amount of 2,160. But in our trial balance we have an amount of 1,620. So this is what we're supposed to get for the whole year, and this is what we only got. So the difference would be 540. This is what we are supposed to add to get this total amount. So we would have 1,620 plus 540 plus the interest on current account, 200 rand, 220 rand. That would give us a total amount of 2,380 rands for our interest income. About bank charges, EFT charges for 170 and our credit card charges for 90 rand. Give us a total of 260. Okay, then we have our last adjustment, which is depreciation. So it says here depreciation on vehicle is 10% on cost. So our vehicle amount would be on cost, meaning that we do not have to deduct our accumulated depreciation for the year. This would give us 28,000 for vehicle. Now for equipment, what we have is 15% on diminishing balance method, meaning that we have to deduct our accumulated depreciation at the beginning of the year. So our cost price is 130,000 minus our accumulated depreciation being 44,600, and we get a total amount of 85,400. So this is for the old. Now we can multiply with 15% for 12 months. Just say 12 over 12, you're going to get the same answer even if you just use the 15% alone. You get a total amount of 12,810. Now we are not done because we bought new equipment of 12,400 rands. So we bought a new equipment of 12,400 rands times 15%. Now the thing is, we bought it on the 1st of December 2023. So that would make it a total of 3 months from December. Let's say December is here, January, Feb, so that would make it 3 months. Over 12 would give an amount of 465 rands for our new. The best way to remember this is by using the acronym SUN. So this is sold, old, and new. Whenever you have a depreciation scenario. Okay, so for depreciation we have 28,000 for the vehicle, 12,810 for the old equipment, and 465 for the equipment that we bought during the year, and that would give us an amount of 41,275. Now we are not done. Let's go back to the top. So our sales would be 581,200. cost of sales, we do not have anything happening with it because we had deducted the cost of sales of donation here, so we cannot deduct it here. It's a transaction on its own, so that would give us a total amount of 161, and then this would be 49,750 to get this amount. Gross operating profit, you'd have to add both these amounts, so that would give us this would be note 4, note 6. Okay, for our expenses, if we add all these amounts, we'd get a total of 139,855. We deduct it to get our operating profit, this amount over here. So your operating income minus your operating expenses would give us our operating profit of 71,095 rands. Now, to get our profit before interest expense, you'd have to add your interest income and your operating profit, and you get a total of 73,475 rands. Now, to get your net profit for the year, you'd have to deduct your profit before interest expense. We deduct our interest expense, not on loans expense.
Note number 3, the fixed asset note. You have your fixed assets, which are land and buildings, vehicles, and equipment, where you get your cost price, which is your initial price that you got your asset with the accumulated depreciation as at the beginning of the year. And to get that carrying value, you have to subtract the cost price with the accumulated depreciation. And for the movement, it's you have your additions, which refers to the during the year, and depreciation, which is the depreciation that you incurred during the year. And to get the carrying value or the cost price at the end of the year, you have to take the cost price at the beginning of the year with your additions, because they're recorded at cost, and then you add them to get the cost price at the end of the year. And to get the accumulated depreciation at the end of the year, you have to take accumulated depreciation at the beginning of the year with the depreciation during the year to get the accumulated depreciation. And for the carrying value, you have to take the cost price and subtract it with the accumulated depreciation as at the end of the year. For inventories, you have your trading stock on hand, stock that you do not use during the year, your consumables, and stationery. Note number 5, trade and other receivables. You have your trade debtors, which you put the amount found on your trial balance minus your bad debt, and then you get the balance. And then you add your accrued income, which is income that you not yet received, that you are to receive over. And you have your prepaid expenses, which are expenses that you paid prior for. And what is cash equivalent? You have your bank balance, your positive bank balance, your cash float and petty cash, and savings account, and your small portion of fixed deposits. Our note number 7, which is the owner's equity note or capital note. You have your balance at the beginning of the year. Any capital contributed during the year, you add your net profit and you subtract your drawings for the year, and then you have your balance for the end of the year. Moving on to our note number 8, which is our last note, which is trade and other payables. You have your trade creditors, your accrued expenses, which are expenses that you haven't paid for, your income received in advance, and the short part of the loan, and your bank overdraft, which is your negative bank balance, and then you have your balance for the trade and other payables.
Hi, greetings. We're going to be doing the provincial assessment paper for Northwest 2024, which will be focusing on inventories, trade and other receivables, cash and cash equivalents, as well as trade and other payables. Here we have our trial balance and our transaction. It is question 3 on our paper. As you can see on our trial balance, we already have our creditors for salaries and sales pay, and we don't have any transaction that speaks on those two, so we're going to take those amounts as easy to our trade and other payables because they are the amount that we owe and we have to pay. So we're going to have creditors for salaries and sales for pay. And we move on to our transactions. So transaction number 1 speaks on amount owed for electricity. That 3,900 is the money that we owe, so we're gonna have to pay for that, which is our accrued expenses that we haven't paid, that we still have to pay. And nothing speaks on that as well, so we're going to record the 3,900 as is. And then we're going to have the commission income received in advance for 15,000, which is our income received in advance of 15,000. And since there are no longer spaces to put any information, so there won't be any information needed for trade and other receivables. So we're just going to calculate the total by adding all these amounts, which will get to 112,900. Moving on to the third transaction about the advertisement, that will go under our trade and our receivables as a prepaid expense because we've paid it. We've paid for it prior. It is 14,000 rands. Moving on to transaction number 4 of packing material on hand, which is our consumables on hand of 7,300 rands. I'm gonna add these together because there's no longer space to record other, which will equate to 317,300. Moving on to our rent owed by the tenant, that is our accrued income because it is income we have not yet received from our tenant, which is 8,000 rands. And then we're gonna add those together, which will be 70,700 rands. And then moving on our second Roman figure note, which will not entertain because it does not it has nothing to do with the notes that we'll be doing. So we're gonna have our fixed deposit note, which is note number Roman figure 3, which is deposit matured, which will be under our cash and cash equivalents of 25,000 rand. Add those together, and then you have your 26,200 rands. And that is it. Thank you for joining our lesson today. Hope you had something fruitful. Thank you.
Hi, greetings. My name is Simphiwe Sithole. As my colleague has explained, what we are going to be doing, doing balance sheet, income statement. I will be focusing on balance sheet, which is the statement of how the business or an entity is standing financially. So this is the format that we'll be working on, and my other colleague will explain the notes that relate to this format. Thank you.
Hi, grade 10s. Today we are going to be doing a financial statement called balance sheet. A balance sheet is a report of the financial situation or position of a company on a specific day. This can be in a year or in a month. They can say that draft a balance sheet on the 30th of June 2023. That's what you are going to do on a specific day. You write a balance sheet, and what we should know is that a balance sheet is set up from the accounting equation. You remember this formula where assets is equals to owner's equity plus liabilities. So it is set up in this formula. So here's the format of your balance sheet. This is how you're going to do your balance sheet. So we're going to start here. When you are given a question paper, the first thing that you should do is that the name of the owner should be present in your balance sheet. You should not leave out the name of the owner because it's a mark as well. Even the name of the business, even the date. This is the 3 things that you should not forget about your balance sheet, because you are writing a balance sheet to present it to the shareholders of the business. So you should include the name of the owner, the name of the business, and the date the balance sheet is done. So the first thing that we are going to see on our balance sheet is the asset. So here's the asset. Remember that we have non-current assets and current assets. Under non-current assets, we have fixed assets. These are assets that are long-term, assets that cannot be easily disposed, assets that are holding the business, assets like land, machines, equipment. They are fixed assets. And then we have financial deposits, financial assets. These financial assets, these are the assets like long-term loans, not loans, but long-term investments like that. These are the financial assets, the long-term investments. So after that, we have current assets. Under current assets, we have inventories. Inventories, it's stock. And we have trade and receivables. Trade and receivables are your debtors. You did that. And you have cash and cash equivalent. You also did that. So after you got your assets, there's a total. You have to do a total here that, I have counted my non-current assets and my current assets, and the total is here. You place your total here. And after you go to equity and liability, remember that we are operating on this equation. So you're going to equity and liability. And then you say under equity, you place your equity line item, and you say you have this certain amount of equity. Equity is the amount, interest or profits that the company has. You can include capital. When an owner invests capital, it goes under equity. Even the investments go under equity. And then you go to non-current liability. Non-current liabilities, these are the liabilities that are long term. So like mortgage bond. You see when you buy bond, like long term loans, things like that. These are non-current liability. And then you have current liabilities. These are trade and other payables. These are creditors. Trade and other payables. These are creditors. And you have trade and other receivables. These are debtors. We are receiving our money, the money that we have to receive from the people that owe us as the business. And this is the money that we owe to other to our suppliers. And we have bank overdraft. Excuse my writing here. We have bank overdraft. This happens when we have a negative bank balance, and we have a short-term loan. Here you include a long-term loan, but here you include a short-term loan under current liability. These are short-term. And then you place your total. You plus this, the equity and your liabilities, and you place your total. So this is how the format looks like. And please subscribe and follow us. Thank you. Good morning, grade 10s. Here we are going to do a grade 10 question paper, accounting paper 1, November 2023. We are using the Gauteng one. So we are going to focus on question 3, which is statement of financial position, which is the balance sheet and the notes of it. If you go check out this statement, this question paper, you're going to find this question on question 3. So the first thing that you do when you find your question paper is that you are going to go to your required. You are going to go to your required and to find out what is it that you are required to do, so that you can go through the question with a highlighter and highlight whatever that is required, so that you can have an idea of what you should look for in the additional information. So we are going to go to required, and on the required, you see here that they want us to prepare notes, 2 notes for owner's equity and trade and other payables. Owner's equity, I told you, it includes capital amount that that the owner is contributing inside the business. It can be even the profit that the owner is doing inside the business. It's what we are getting there on the owner's equity. And trade and other payables are the people that we are owing, the debts that we as a business are having. These are creditors. And number 2, they want us to complete the equity and liability section of the statement of financial position. So we are going to complete that. So right now, when we go through the information, the question itself, we find information and we find an extract of from a pre-adjustment trial balance, as you can see here, and the date is 31 July 2023. So we are going to use this extract. That means when we go to our required, the statement that we are preparing is for 31 July 2023. So we see that on the 31 July 2023, the owner had these amounts. Ne? But this doesn't mean that these are the amounts that are correct, that we should include in our statement of financial position, which is the balance sheet. Statement of financial position and the balance sheet are the same thing. So you see here, it's a pre-adjustment trial balance. So we are trying to balance this this trial balance. So we're going to, there's information that is required that should be added in this so that it can be complete. So that's what we are going to do. So we are going to include our, we are going to go to our additional information. And as you can see here, we have additional information and the adjustments that are not recorded. So the first thing that they told us to do is to do a note for owner's equity. So we're going to start with a note for owner's equity. So when we start with the note for owner's equity, we are looking for capital. We are looking for anything that has to do with capital and profit. That's what we are looking at. Even drawings, 3 things. We are looking for profit, capital, and drawings. Those are the 3 things that we are always checking when we are dealing with owner's equity. So Here they say Jasper Savage invested another 100,000 cash in the business on the 30 June 2023. It has not been added. We have to add it. The Jasper Savage invested another 100,000. That means the owner put in another 100 capital inside the business, which is 100,000 rands. So we are going to team it off, and we are going to use it as what you call as capital. We are going to include it in our owner's equity. And then there's net profit for the year amounted to 170,000, and it has not been re-entered in the books. So profit, we are looking for capital, profit, and drawings. So we have to include this amount inside our owner's equity. We are going to mark it off. And then Jasper Savage took additional merchandise with a cost price of 40,000 for personal use. The owner took additional merchandise. When the owner takes something from the business, that means it's a drawing. Whether it's money or anything like stock, anything at all, it's a drawing. So we have to include the drawing. We are going to minus it on the owner's equity because the owner is taking from the business. So we are going to mark it off. And when we check other information, like that's where it ends there. So we are going to include it in our what you call in our owner's equity. So when we go to our owner's equity, we are seeing here that the balance that we had on the 1 July 2023 was 3 million. It was 3 million, the balance that we had on our balance or on the last pre-adjustment. And I want to show you something here. On the pre-adjustment, the capital that we had was 3 million. So we're going to add onto it that the capital balance on 1 July 2022 was 3 million. So we're going to add the additional capital contributed by the owner. You remember the capital contributed by the owner. We are going to include it, the net profit, and from the drawings, we are going to add the 40,000 of the personal use he took. Because you have seen, this is how the owner's equity note is going to look like. Your drawings. These drawings, we have them from the statement, from the question, the drawings that we had for 200,000. So we're going to add the things the owner took. The question says, Jasper took additional merchandise with the cost price of 40,000 for personal use. These are drawings. So we are going to include it in that 200,000, and we are going to minus it here. So we're going to add 3 billion from the capital balance that we got, and 100 additional capital contributed, and the 170 net profit made, plus and minus 240, it's 240, and then we get 3,030,000 rands. So this amount, we are going to include it in our statement of financial position under equity. So right now, we are going to trade and other payables. So on trade and other payables, what you look for mostly is for people, creditors, people that we owe. So you are going to check here which amounts do we owe and to whom. So here they say a debtor returned 3 industrial ovens with a selling price of 75,000 each. So they are going to trick you here. They're saying 3 industrial ovens with a selling price of 75,000 each. So you're going to say 75,000 times 3. So each industrial oven costs 75,000, and there are 3. So you're going to do the maths, and you're going to end up with 112,500 when you times 75,000 with 3. And they say upon inspection, a Savage trader found all 3 ovens were not working and subsequently returned to the supplier. So we are going to minus it because we were owing the supplier money. We're owing our supplier money, and we're owing because of the stoves that were at fault. So we are going to minus it from our creditors amount. And then here they are saying baking trays costing total of 3,000 were purchased on credit from the supplier. However, they were posted as indicated in the table below. Correct the error. When you look at the table here, they are saying debit credit is trading stock and credit bank, which is incorrect. You have to credit. When something is taken on credit, you have to put it on creditor's control. So here there has to be creditor's control. So this is the error that we are going to fix. This means that we are going to add this 3,000 on creditors. So let's mark here the things that we are going to include in our trade and other payables. So we're going to mark them. We are going to start with the industrial stoves. We are going to mark it, and then we are going to baking trays. We have to pay, correct the error, and then we are going to number 6. This is the statement received from SWY Bank on the 31 of July. They are talking about a loan here. So they are talking about a loan here. So we are going to include it on its own. So we are going to another. There's a statement of telephone account was only received a few days after 31 July, 2023. The amount of 600 will be paid in August 2023. So here it's an accrued expense. We have not paid it. We have gained the expense. We have earned the expense but not paid it yet. So it's an accrued expense. It's part of the trade and other payables. So you're going to mark it as well. And you're going to say accrued expense. And we're going to number 8. One of the debtors had paid 12,000 for servicing electric stove. Due to load shedding, the services will only be done in August 2023. So here we have received 12,000 for servicing electrical stove, but due to load shedding, we have not done the job that we are required to do. So that means we are owing one of our debtors 12,000 because they've paid, but we have not done the work. So this is a payable that has to be done. So we're going to mark it and include it, and we're going to say it's an income received. Sorry about that. It's a bit windy. So we are going to mark it as prepaid, as income received in advance, which is a credit. It's part of the payables. So here, Savages employed a new sales assistant at the beginning of July. Human Resources Labor Department had not processed the assistant information, and he was not paid for July 2023. So here we are dealing with someone that has not been paid money. So his gross salary is 15,000. His payee is part of SARS. So we are paying SARS on behalf of this individual. So we have to pay SARS 2.100, and we have to deduct 1.500 of his gross salary. We have to also deduct the medical aid that from his salary, and we are going to deduct all of this money, and we're going to get a net salary. So we're going to say, let me do the maths quick. So after deducting, we are going to get 10,100. this is the money that he is going to receive. This is the salary that he's going to receive after deductions. And then here, these are what we as a business are contributing. So we are going to contribute to the pension fund, R2 for every R1 deducted. So pension fund. So we're going to double this amount, and we as a business are going to deduct. We are going to pay double this amount to the pension fund. So it's a payable as well. And medical aid on a rent for rent basis, that it's 1.3, like it's the same amount. So let's go to our so here is it. So our trade and creditors, remember we received this thing, creditors control at the beginning of the year. It was 530,000. So from 530,000, those stoves that we had for 75,000, here are the times 3. These are the stoves that we had. So we are going to deduct them because they are faulty. We have returned it to the supplier, so we are not owing the supplier anymore. So we're going to deduct it, and we are going to add the 3,000 that 3,000 that the baking trays cost that were purchased on credit. So we're going to add it, and we're going to receive this amount. And then for pension fund, we had a balance of 19,000, and we are going to add the 1.5 that the employee is going to contribute, and the 300. Remember that we are doubling this amount, so we're going to have the 1.5 thousand and plus the 3,000 that we as a business are going to contribute, and we're going to get a total of 23,500. And for medical aid, the balance at the beginning of the year was 17,000. The employee is contributing 1.3 thousand, and we, for rent on rent basis, we are going to also contribute 1.3 thousand. So when we do the total, it's 19,600. And for accrued expenses, this is the amount I was talking about. After completing your note for owner's equity and trade and other payables, you are going to the statement of financial position. You are going to find an account like this. You are going to include your equity that you got from amount that you got from this section. You are going to include it here, and you are going to also include the 250,000, the 240. We are going to minus 60,000. That was not that you have to pay to the bank for the non-current part of the non-current liability. As you'll minus it, because you have to take 25% of the outstanding balance on loan. So you have to minus it also as well. So you're going to minus it, and you're going to go to current liabilities. On the current liabilities, these are liabilities that are short. Trade and other payables, you included here. Long-term loans, you are going to include it here. And bank overdraft. Remember that we had a bank overdraft. Excuse me. So these are the amounts that you're going to get, and your bank overdraft here. So these are the amounts that you're going to get. This is how your statement of financial position is going to be like. Please like and follow and subscribe.
Ladies and gentlemen, if you reach this point in the video, you should have obtained the following outcomes: knowing what an income statement or statement of comprehensive income is, and what a balance sheet is, or statement of financial position. A statement of comprehensive income is a financial report of all the company's income and expenses over a period of time, which we call a financial year. And it shows if the business made a profit or a loss. And then a balance statement is a financial report of the business assets, liabilities, and shareholders' equity at a point in time. It also takes the form of the accounting equation, which states that
assets are equal to liabilities plus owner's equity. By now, having reviewed the work from Umpimedzi, Ovayo, and Simpiwe, you should be able to detect and rectify these following mistakes. Mistakes that learners make is time, knowing how to manage time as well as comprehension. Some learners just read a question and just rush to calculate instead of understanding what the principles are. Students tend to confuse between the terms accrued expense, accrued income, prepaid expense, and deferred income. And having those explained by Ovayo will clarify this confusion for you. So students tend to make mistakes with the depreciation methods. We have the cost price method, or known as the straight line method, and the diminishing method. So with the cost price method, you just take the cost price multiplied by whatever percentage you're given and the number of months that you had the asset, because there are instances where we have bought the asset in between the year and not having it at the beginning till the end of the year. Same with the same month through applies with the diminishing method, but in this case we take the cost price and then we deduct it with the accumulated depreciation times the percentage times the number of months. Thank you.